Welcome to a webinar on tax law changes, updates the US and India organize under the aegis of Indo-American Chamber of Commerce in collaboration with the California Lawyers Association International Law and Immigration Section.
There are about 18 sections that cover a variety of law practices within CLA, and it includes taxation law, business law, criminal law, labor law, international and immigration law as well. I'm the vice chair of the International and Immigration Law section. It's also known as ILS, a lot of abbreviations here. ILS represents CLA in its relations with the foreign bar associations and lawyers associations across the globe. We achieve this through our friendship agreements with law societies and bar associations. And we engage with foreign peers to produce educational programs such as this event. And we also promote the rule of law all over the world. Last year, ILS was with a group of its delegates, went to Barcelona, Mexico, and Japan to gain insights into the judicial structure of those countries. This year, we will be in Italy in conjunction with the Milan Bar Association in October of this year. We work really hard, but we are a fun group. Our membership is a mix of international attorneys, arbitrators from across the globe, immigration attorneys, as well as international tax attorneys. We are in the midst of a membership drive, and I take this opportunity to invite you to join our section to explore how we connect and support the legal community and other communities as well. By the way, Neeraj Bhatia is one of our esteemed members in the executive committee and with ILS, and I'm really looking forward to his presentation this evening. And again, thank you for having me here. I'm excited for this evening.
Great. So thanks a lot for that. I think a lot of your information will be useful for our members. Quite a lot of things happening around these days. Good. So next, I would like to extend a warm welcome to our special guest. Our special guest is Deputy Consul General at the Consulate General of India in San Francisco, Mr. Rakesh Adlakia. Mr. Rakesh Adlaka, Deputy Consul General at Consulate General of India in San Francisco, is an officer of the Indian Foreign Service. He has vast experience of working in various capacities, both at the headquarters of the Ministry of External Affairs of India, as well as Indian diplomatic missions abroad. Mr. Adlaka joined his duties at the Consulate General of India in San Francisco in January 2023. Previously, he was Deputy Chief of Mission at the Embassy of India in Muscat, Oman, and he also served in the Indian diplomatic missions in France, Sri Lanka, and Malaysia, as well as Indian delegations to the United Nations in New York. At the Consulate General of India, San Francisco, Mr. Adlaka is responsible for community, cultural, as well as political affairs. Mr. Adlaka is a graduate from Delhi University. He likes reading and listening to music. His family consists of his wife and 2 sons. Mr. Adlaka, do you want to say a few words for the audience?
Yes, thank you for this kind introduction. I hope I am audible.
Yes.
Okay. So I'm happy to be with you all, though virtually, for participation in this special event on the tax law changes in USA and India. I must admit that I am not an expert on the tax laws, but I would like to use this occasion to share a few thoughts about India-US bilateral relationship, which we work towards strengthening all the time. So let me begin by thanking the Indo-American Chamber of Commerce, which is organizing this event with the support of International Law and Immigration Section of California Lawyers Association. It is an honor and pleasure for me to have been invited. Friends, it will not be an overstatement to say that the US-India Comprehensive Global and Strategic Partnership is the defining partnership of the 21st century. The partnership between the two countries covers virtually all spheres of human activity. To name a few, there is close cooperation in defense, security, strategic affairs, space matters, clean energy, education, health, science and technology, etc., etc. US is India's largest trading partner and is also the third largest investor in India. But of course, there are Indian companies also which have invested in USA. As per the CIA report last year, there were 163 Indian companies which have invested over $40 billion in the US and created over 425,000 direct jobs. And friends, you are aware of the India's growth story. India has been growing over 8.2% in the last financial year and is expected to grow with the same pace in the coming years. India is the fifth largest economy of the world and is expected to become the third largest economy in the next 3 years or so. Its GDP is projected to reach $7 trillion by 2030 from about $4 trillion presently. There are some important factors which are leading to India's growth, like India's aspirational and youthful population, with an average age of 28 in comparison to 38 in the USA and 39 in China. India has huge working age population, large consumer market, reforms undertaken in the last few years, and an innovation-friendly governance, both at union and state levels, is ensuring that India will grow between 8 and 10% in the coming years. India has the third largest startup ecosystem in the world, with over 146,000 startups and 115 unicorns as of 2024. The Government of India has undertaken various measures under the Startup India scheme to foster a more vibrant and dynamic startup ecosystem that encourages innovation and entrepreneurship. India has a strong AI ecosystem and competitive edge due to its vibrant digital economy, excuse me, abundant data, and talented workforce. Digital public infrastructure, the India Stack, is set to drive India towards a $1 trillion digital economy by 2030. AI is expected to be the flag bearer of this rapid growth of the Indian digital economy by boosting productivity and efficiency. The AI market in India is expected to increase from $9 billion in 2023 to $22 billion in 2028. India's AI market is likely to grow at par with the global market, with focus on financial sector, the tech sector, healthcare, education, media, e-commerce, retail, manufacturing, and automotive industries. All these factors present a big opportunity for the Indian and US companies to further expand their investments. Of course, tax laws of a country are an important consideration when investing in that country, and therefore I feel that this special event is very useful and will help us in updating ourselves on these issues. Once again, I thank the organizers for hosting this wonderful event and inviting me to join. Thank you.
Thank you very much. That was very informative. A lot of opportunities, I think. So that is really good. So finally, we are at the main segment of the event. The latest changes, tax changes and updates for US and India, for which I would like to welcome Mr. Neeraj Bhatia. I'll give a brief introduction to Neeraj ji. Neeraj Bhatia is an accomplished lawyer and an accounting professional with 35 plus years experience in international and domestic tax planning and compliance for startups and multinational entities. He specializes in international tax audit and review, accounting, compliance and reporting, immigration services, and corporate compliance with offices in California, New York, and New Delhi, India. His engagement in the US and India includes cross-border tax planning and transactions, M&A corporate structuring, and complex tax audit and representation, including recent overseas disclosure programs. Streamlined disclosure programs are also part of which he covers. His clientele includes startups, multinational companies, government organizations, public sector banks, and auto dealerships. Neeraj Bhatia has presented extensively in US and India on tax issues. There are a lot of things I can talk about as far as academic qualifications and professional qualifications. They are quite a long list, but I'll summarize. With most of his education in Delhi and chartered accountancy from India as early as 1983. He also did cost works accounting from India, and then later did further education in Colorado State, where he got his CPA and his LLM degree, which is the law degrees, are from Florida and California. He's an attorney with the State Bar of California, which he passed in 2021. He's held numerous positions in a lot of non-profit organizations. So if you ask me to read out the list, it is quite a lot. But he just told me to just say that there are a lot of organizations he is very closely involved. One of them is University of Silicon Andhra, where he's a director. Um, and he's also part of a lot of some organizations and associations with lawyers as well as immigration and chartered accountancy. But I think what is very different is that he he's got a lot of awards, and as far as awards, he was the first rank is in cost and works accountant in North India, and he's got a lot of scholarships for that. And he was also awarded Hind Ratan Award on the occasion of Pravasi Bharatiya Divas by the NRI Welfare Society of India in 2018. So without much delay, I would like to ask Neeraj ji if you can start your webinar. Uh, the only instructions for attendees is if you have any questions in the chat, please put it in the chat so that Neeraj ji can take it up. But over to you, Neeraj.
Good evening, everyone. And that was a long introduction, Viraj. I was not expecting so much, but thank you so much. And I want to thank Indo-American Chamber of Commerce and California Lawyers Association, the Immigration Law, International Law and Immigration section, for allowing me to speak and address on certain issues which are there. And special thanks to Rakesh Adlakaji, who has spared his time, valuable time, to be here. I know the consulate is busy with helping the Indian community in every aspect possible. And it was also valuable to hear his insight on the developments between India and US, and especially the progress we all know India is making. And so it's very important at this time of the partnership between the two countries. So thank you so much for joining us and for your kind words. There are a lot of changes happening both in India and US. India, as we know, there's a whole Income Tax Act also has been, there's a new one which has been tabled in the parliament, and which is now in it's being tabled in the parliament. So it's going to be debated, and probably soon it will be enacted into law. And in US also, we are seeing changes happening every day. We are anticipating a lot with the new administration coming in. There is one bill which was tabled and passed in Congress yesterday, and which is still got to go to Senate. We'll talk about that in our presentation. Okay, so we are going to talk about the tax law changes and updates between US and India. This is the brief about me. I think there's a lot already said about me and our firm. So these are the topics which we are going to cover. One is the beneficial information reporting. It's very significant right now for all the businesses operating in US, and it's been going through a lot of battle in federal courts, but now it's going to be effective very soon. And then we are talking about US tax changes, which are basically more of inflation adjustments based on prior years, and likewise in California tax changes. And then there are some changes which are proposed, which are going to be there. Then there is the Trump's first term's TCJA Jobs Act, which was enacted in 2017. Most of the provisions are going to sunset this year, although the proposal is there to extend them. So we'll be talking about that. And then there is a last bit of employee retention credit left because there is a last final deadline of April 15th, 2025, which will be there. And then for the NRIs and foreign investors, India's budget in 24 and 25, the interim budget in August 2024 and the recent one in 25 made some changes, which we'll be talking for NRIs and foreign investors. And also, of course, what are the compliance requirements for NRIs and foreign investors here when they are doing investment overseas. So first we talk about the beneficial information reporting. This was actually enacted by the Corporate Transparency Act in 2021, and it was supposed to be effective from January 1, 2024. So many of the companies, businesses have started filing since then, but then it was in federal litigation almost throughout 2024, and a lot of seesaw battle was there in December. Once it was stayed, then there was an injunction, then injunction was lifted, then again reimposed. So finally, on February 2025, Federal District Court has lifted all injunction. And as of now, they have March 2025 is the new deadline for mandatory BOI filing. So it is mandatory. Almost all businesses, other than sole proprietorship, have to do this filing, and they have to be filed with the FinCEN. But FinCEN is saying that they are still assessing the options. They may modify certain deadlines to provide some relief to small businesses. But as of now, what it stands is that almost all businesses which are incorporated in the US have to file. So the reporting companies are categorized in two categories. One is domestic reporting companies, which is corporations, LLCs, and any other entities created by any filing with any Secretary of State or similar offices in the US. And likewise, foreign companies who are operating in the US and they have got a certificate of authority to business in the US through filing with Secretary of State, they also have to file. There are 23 specific type of entities which are exempt. We'll come into the next page on that. And very large companies are exempt because generally because they are doing other filings through SEC and other compliance are there. So those are exempt. So large companies are where they have more than 20 employees. They have presence in the US and their gross receipts are more than 5 million from sources within the US, as reported in their federal return. So these are the 23 exemption, mainly some non-profit entities, investment companies. Most of these companies have other compliance and reporting requirements. That's why they are exempt. And non-profits do not have owners. So it's essentially for the ownership and control which are reported. The reporting is to be done with FinCEN electronically through their website. This started in January, on January 1, 2025. Initially, they had given January 20 till 31st January 24 to file for all the prior years. Those existing entities were given the whole year to file. And for those which were incorporated or formed in 2024, they'd been given 90 days to file. And going forward from 2025 onwards, they had 30 days to file. But since everything was stalled during the year, everything was pushed. And now March 21 is the deadline for all the entities which are existing. And any new entities, they have 30 days from the date of formation to file this report. So any updates or corrections, they also must be submitted within 30 days of such correction or updates. And there are severe penalties for civil penalty of 592 per day for non-filing. There could be criminal penalties as well, as you can see. And what it's the information which is required from the company, basically the legal name of the entity, their address, jurisdiction, the EIN have to be done. And then details of beneficial owners have to be given, which are basically who are the beneficial owners, who are under control of the company. If the companies are controlled through another entity, then who's the ultimate person exercising the control over the company? It could be another officer of one of the parent company or whoever are listed as officers, director. in the filings. Their biographic details are required, unique identification number, passport, license, and all. Then also required is for company applicant. These are basically the promoters, the incorporators of the company, this is not required for the old companies which were existing before 2024, but going forward for all the new companies, that also has to be reported. And now let's come to the US changes which are there in 2024. And of course, for 24 file is there where the filing has to be done now. And for 2025, which since we are in that year, what changes are there? So highest slab remains the same at 37%. I will not go very detailed into this. These are there on the screen, but essentially for merit filing joint, for the limit is 731,200 for 2024 and 751,600 for next year. And the lowest slab, which is exempt, is for merit filing joint is 23,200. Standard deduction also goes up. Most of these are inflation adjusted every year. They are predetermined based on the inflation, how much is going to be there. Long-term capital gain is exempt now for the year 2024 up to an income of 94,000. If the joint income is below that, overall AGI is below that, then there's no long-term capital gain. And the maximum, the higher slab of 20%, because normally it's a 15% slab, but 20%, the higher slab starts for 2024 at 583,750 for merit filing joint, and for 2025 it will be 600,050. AMT is kicked in at beyond a certain threshold for certain filers. Again, there are certain other unearned income for minor has inflation adjustments, minor changes. HSA, there are some changes. 199A deduction, this is the qualified business income deduction, which came through the Jobs Act, which we'll be talking further because of the sunset provision also. But as of now, for 2024, the threshold is at 383,900, and it phases out at 483,900 for certain categories. So these are mainly for pass-through entities, for ESCOP, LLCs, and wherever the business is there, the self-employed business also qualifies in this. For 2025, there is again some inflation adjustment. And for 2026, of course, there is a question mark going forward. Interest on education loan also again stays at 2,500, but there are inflation adjustment for the threshold deduction. Standard mileage rate is up for 70 cents per mile and 67 for 2024. This is for the business where you're filing, individuals are filing Schedule C or for the corporate returns. But as a miscellaneous itemized deduction, it has been, for federal purposes, it has been suspended from 2018 to 2025, again because of the Jobs Act. So whether it gets introduced again or not, we'll have to see. Foreign earned income exclusion, this basically applies for people who are not living in the US or living in the US for not more than 30 days, basically US citizens or green card holders who are mainly residing overseas in India or elsewhere. So they can, from their earned income, they can claim this much exemption. If it is for 2025, it'll be up to 130,000 for 2025. And there is some, you can add housing exclusion also on top of this. So estate tax is one other significant thing which we are, everyone is anticipating what's going to happen there, because for 2024, the exemption is 13,610,000 per person, and for 25 it will be 13, almost close to 14 million. And for a married couple, it becomes 28 million for 2025. But after that, it's going to drop to half if because again, this is part of the Trump's Jobs Act 2027, and if nothing is done, then it will sunset and drop to nearly half of this. Annual gift tax exclusion for 2024 is 18,000. For 25, it will be 19,000. And IRA contribution and 401k are also basically inflation adjustment. The only significant thing in this is the Secure Act has introduced from 2025 onwards, for those who are in the attaining at the age of 60, 61, 62, and 63 in this year, they can do an additional catch-up contribution over and above. Normally it's 7,500, but they can do up to 15% of their basic limit. So it will be for 2025, it will be 11,250. And IRA contribution stays at 7,000 in 2025. Defined benefit plans, the limit goes up slightly. Again, child tax credit and earned income credit, these are normal adjustments. Bonus depreciation is in a phase out, say again, part of the Jobs Act. And for 2024, you can qualify, get up to 60%. And for 25, it will be 40%. It's under phase down, which will change depending upon what happens. And 179 depreciation also has its inflation adjusted limits. 1099K, which is for the merchant accounts reporting, that has been going through changes. As of now, up to 5,000, those who have income of 5,000, they are going to be reported. They are wanting to bring it down to 2,500 from 25 onwards, so that more and more reporting is done by the merchants for those businesses who are accepting credit card payments. For California, not much change except an invisible change of SDI by 0.1%. Those who are getting W-2 income, their amount will go up by 0.1% this year. Last year, I don't know if people noticed or not, there was a significant change in SDI because there was an upper limit of 153,000 last year, which was lifted. So basically, if somebody was, let's say, in the $1 million bracket and all, they would have seen for $1 million income, the difference was nearly $10,000 in the SDI alone. And overall, the top bracket, if you add the SDI, becomes not 13.3 for California, it actually becomes 14.5 for those on getting W-2 income. And again, standard earned income credit and standard deduction are normal inflation adjustments. So now this, just yesterday, that's February 25, the House of Representatives has passed a budget resolution where sweeping policy changes are expected to be made. It was passed by a very slim margin of 217 to 215. But again, we still, it's a lot has to be seen what happens to this in Senate, because even they were able to muster in Republican majority also. It was an effort for the Republican Party. What it expects is there is an expectation to extend the 2017 tax cuts and Jobs Act provisions to make them permanent. 20% small business deduction, which we talked about, also to be made permanent. Extension of opportunity zone incentives, which was also part of the act, to be extended. Full details are still not out, but these are some of them. And they want to end Social Security and tips and overtime pay. That's one of the proposals which President wants. And some of these are probably going to be contingent on federal spending thresholds. So we'll have to see what happens finally, because these are just proposals. Likewise, there are a lot of proposals which are there in Congress. One for eliminating federal tax, eliminating estate tax, eliminating payroll tax, abolish IRS, and things like that. There is one on having a flat sales tax, which we keep hearing off and on. And then to really make just keep sales tax and remove everything else. But again, this has never seen the light of day. The key provision, if nothing happens, which are going to sunset this year on 31st December 25 are marginal rate, which will go up from 37 to 39.6. Standard deduction will be reduced to nearly half, but then personal exemption will come back, which has been zero under the Jobs Act. So then credit for dependent, which was temporarily there, which will go. State and local tax deduction was capped at 10,000. That in California and New York, some of those states, people here have been hit with this. This cap was brought in by the Jobs Act, so that should get lifted. Then estate exemption, as I mentioned, will drop to half. Child tax credit will change. Moving expenses were removed by the Jobs Act. Basically, if any employee working for one company moves to another state and incurs moving expenses, it was allowed as a deduction, but Jobs Act removed that deduction. Mortgage interest deduction in California, we have seen because all the houses are new houses are nothing is less than $1 million. So, the limit on deduction is capped at a loan of 750,000 for the new loans. That should revert to 1 million, plus the interest on home equity debt adds to another 100,000. Charitable deduction as of now is capped at 60%, which will go down to 50% if with the sunset. Personal and casualty deduction was removed, which should probably come back. Then another significant is the itemized deduction for miscellaneous expenses. These are a lot of people, salespeople and all that, they have unreimbursed employment expenses. That was completely removed with the Jobs Act. Some should come back as part of the itemized deduction if there is a sunset of these provisions. Overall limit of itemized deduction also was originally capped at 80%. And then some changes in AMT and moving reimbursement expenses, because that moving reimbursement also gets reported through the employment, the W-2. That also will see changes. On the business side, pass-through income deduction, as I mentioned, was as part of Jobs Act. That may go away if there is a sunset. Resultant to that, in California and some state passed a PT tax deduction, pass-through entity tax deduction, where they did a workaround to the 20%, 10,000 cap actually for the itemized the salt deduction, state and local tax. So in the PT tax, they are paying the tax through the pass-through entity, S Corp or LLC. And this is tied to that 199A deduction, so and salt deduction. So that also will go away then. Bonus depreciation will change. Business interest deduction is capped at a certain threshold. That limit will go. There's limitation on loss on non-corporate taxpayers, which should also change, and higher exemption limit for AMT will probably revert. Also, paid family and medical leave will change, will not get a tax credit. Qualified opportunity zone tax incentives were introduced as part of the Jobs Act, which are going to sunset. But this anyway was likely to get extended because a lot of investments have been made in various rural areas, where upcoming areas where and this one provision even Democrats wanted to extend for a couple of years because of the downturn we have seen in the last couple of years, especially since COVID. And so a lot of investment in these zones have not really produced the result because of the things. So they want to extend the provisions. Because actually the tax which are there, they are tax the investment which are done in operations are through the capital gains to defer the capital gains till 2026. So they want to extend for a few years so that the taxpayers do not have to pay tax immediately, and it can get deferred for some more years. Able accounts and savers credit was also introduced, and that will also probably go with the sunset. Employee retention credit has a final deadline of April 15, 2025 because of the statute of limitation for filing amended returns for 2021. This was part of the COVID relief which was there, and those who did not claim in time, they still have time for 2020 2020 year filings have already passed the statute, so they cannot be claimed for 2020 anymore. But for 21, they can be claimed, but just for another month and a half or so. Claims can be withdrawn without a penalty if anybody wants to do that, because there are a lot of dubious claims also which have been there. They are under radar of IRS. For 2021, the amount of claim is about 70% of qualified wages paid for each quarter, limited to 10,000 per employee. So basically, the amount can be 7,000 per employee per quarter for 2021. And this was for the first three quarters, basically allowed. Fourth quarter, they had discontinued for 2021, but they came back in only for recovery startup businesses, where there's a limit on of 50,000 per calendar year. Now let's come to some changes which are there for the India, which came in the India budget. The interim budget, first was the interim budget, which came in August 2024. Some changes were there. The standard deduction and pension, and those were mainly for the residents who are living and working in India. But for businesses, there was abolition of angel tax, which was 30% tax on high value funding was there, which was abolished. Corporate tax was reduced from 40 to 35% for attracting more investments, which benefits those who are investing in various businesses in India. And cruise industry, they had introduced a sort of a presumptive tax regime so that it makes easier to anticipate what the taxes and are there. TDS and TCS compliance, so tax deducted and source and collection, was the benefits were eased by allowing credits to be claimed for both of them. Certain changes were there at that time. The rates were changed, and they also have been changed again in 25. Some benefits have been there. Capital gain, the biggest change actually was the capital gains, the regime, the way capital gains is calculated. So India used to have indexation of the capital gains based on when the property was purchased and adjusted for inflation going down the line for the years. They used April 1, 2001 as the base year. So any property which was purchased prior to that, they would take the fair value as on April 1, 2001 as the base, as the value of cost basis, and then apply an inflation rate year wise on that. So something which was, let's say, purchased for 100,000 in 2001 would be equal to about 400,000 in 360 or 370 in 2024. But then they removed this indexation, and the long-term capital gain used to be 20%. They brought it down to 12.5% flat without giving benefit for indexation. They also did standardization of holding period of 12 months and 24 months, basically short-term. For listed company, 12 months becomes the long-term. Anything more than 12 months becomes the long-term gain. And for all the other assets, more than 24 months if you're holding, then they qualify as long-term gains. Now this has mixed impact because essentially the thumb rule was if any asset has appreciated by more than eight times since 2001, they would benefit with the reduced tax of 12.5%. So the loss on indexing will be more than offset with the reduction in rate from 20 to 12.5%. There were a lot of protests in India. So for some time, they have actually allowed, for the Indian resident, they have allowed the taxpayers to use either of them, either the old method or the new method, whatever benefits them. But this benefit was not extended to non-resident Indians, NRIs. Although in this interim budget itself, the one of the proclamation was to have parity between residents and non-residents in respect of many changes, but somehow this didn't happen. So how the new capital gains impact, it requires careful planning because there are a lot of options for reinvestment either in India or here. So under the old method, the way it was calculated was capital gain would be sale proceeds minus indexed cost of acquisition, and then you pay tax on capital gains at 20% long-term gain. And under the new method, it becomes sale proceeds minus the cost of acquisition. So, and cost of acquisition is either the actual cost or the fair value as on 2001, April 1. And of course, you apply 12.5% rate on the long-term gain. For I mean, there are a lot of tax saving options both in India and the US. Why you need planning is where if you want to reduce tax, plan in advance. There are you can reinvest the proceeds for either 3 years or 5-year lock-in period after investment, depending upon the way what asset has been sold. Then the proceeds can be reinvested and the tax can be saved in India. Then profit on sale of property which has been used for residence for at least 3 years, whether self-occupied or rented, can be used for purchase of another residential house in India within 1 year. 1 year before, and then it became 2 years after the date of sale. Either 1 year before or 2 years after the date of sale, if it is reinvested, then the tax can be avoided in India. I mean, it will give you, but capped at 10 crore now. Then reinvestment can be made in National Highway Authority or rural electrification bonds up to 50 lakhs within 6 months of the capital gains. Or reinvestment of net proceeds on long-term gains other than residential house in a residential house, provided the taxpayer doesn't already have more than one other house. Now, also there are options in the US also. Now we come to the tax in the US. So basically we need to do a balancing between India and the US. So first of all, in US there is no indexation, but the taxpayer can still get some benefit, indirect indexation because of foreign currency difference. So basically, if something was purchased, let's say in 2005, when the tax rate, conversion was around 40s, and today it is in 80s, the cost basis automatically becomes double based on this difference in dollar terms, as vis-a-vis the sale. And if in case somebody, let's say US citizens or green card holders, they are living in India for some time and it is a residential property where they're living as primary home, they can claim the same exemption here, which is for joint filers 500,000 and for single 250,000 they can claim as exemption. If it's an inherited property, US allows a stepped up basis of fair market value on the property on the date of death of the original owner, which is not the case in India. So that's a big advantage here in the US. The people have to be careful because a lot of times they confuse with a gifted property versus inherited property. This doesn't apply to gifted property, but on inherited property, it does apply. So, and then in community property states like California, when one spouse dies, for the other spouse, the entire property, the basis is stepped up to fair value, which is another big advantage. Then US also affords other tax deferment option, though not tax saving, which is investment in 1031 exchange or investment in opportunity zone, which was part of the Trump's Jobs Act, and if it is likely to get extended, that will be another option to defer tax gain. And then passive losses on investment properties overseas can be claimed in the year of sale, where they have been. I mean, when somebody has a rental property where the person is not able to claim the passive losses because of the income threshold, then in the year of the sale they can still claim. Once the sales are done, people can remit the money from India to the US. What they need to do include the India capital gains in their return, pay taxes in India, get a tax clearance certificate from a chartered accountant in India, file form 15CA and submit to the department, and another 15CB is also filled in the bank. And up to 1 million can be remitted per financial year. And besides that, under liberalized remittance scheme, LRS, and 250,000 in any case can be remitted from India to the US. 2024-25 budget also had, we saw some more changes. One, the big which was in the news, that Mrs. Nirmala Sitharaman had significantly increased the income tax threshold from 7 lakh to 12 lakh per individual to make it so up to 12 lakhs totally without tax. But this is only for those who are filing return in India as residents. So for non-residents who are living in the US filing return in India, they don't have, this benefit doesn't apply for, but for them also threshold was increased from 3 lakhs exemption to 4 lakhs exemption. But some of the other benefits for NRIs and investors have been increased in the threshold for tax deducted on rent. Earlier, it was up to a rent of 2.4 lakhs per year. Now it's 6 lakh annually, but actually it's not 6 lakh annually, it's 50,000 per month, which for 12 months comes to 6 lakhs. So that was pointed out by many people when the finance minister was making a speech. So then TCS on educational remittance, this is one important a benefit for students who are studying in the US. If they have taken loans from any financial institutions in India for their education abroad, there will be no TCS on such remittance, which is a major thing. Otherwise, because they had to first send the money, the parents had to send the money, and then on top of that also pay extra TCS, which has been completely removed now for if these are through educational loans taken. And in any case, TCS on remittance has been increased from 7 lakh to 10 lakhs. Plus, there are a lot of other simplification in TCS and TDS processes for ease of compliance, and rates reduction also has been there. The long-term gains on securities transferred by non-residents is taxed at 12.5%. It is aligned with the other thing. This was probably some changes which were required to make them in parity with other things. There is one important thing is that now updated returns can be filed up to 2 years. It was earlier, first it used to be 1 year, then it became 2 years. Now it's been extended to 4 years. But this is restricted where you have missed reporting some income in India and you want to now pay tax on that. They have given more time for that. It may not be for filing a claim of extra refund, which you missed claiming. In India, if you own properties, the rental value is, the notional amount is taxed. So, but now up to 2 self-occupied properties can be exempt, which if a lot of NRIs hold multiple properties, so they can, if they are just owning, they're not rented out, 2 of such properties can be claimed as exemption from tax. And again, securities held for investment will be now capitalized as capital assets. Part of it was being taxed as ordinary income. So that change is there. And another benefit is that withdrawals from NSS and PS Vatsyala accounts, they are exempt from tax from August 29, 2024 onwards. Presumptive tax is there for non-resident, those who are, if they are providing services to for electronic manufacturing, somebody is doing business in that. They have made it easy where you can just pay 25% without, make it simple for tax purposes. So they can assume 25% of the gross profit as a deemed profit and pay tax, because at 35% tax rate, it comes to less than 10% on gross receipts as the tax. So they can do a simplified way of paying tax in India on such transactions. Non-residents who are purchasing goods in India will not be deemed as having significant economic presence, because otherwise tax in India is levied based on the transactions also that you have nexus with India and you're doing business over there. But if you're purchasing goods purely for export, they will not be deemed to have any significant economic presence, and they'll be exempt from India tax. Then startup tax benefit, it's been for the last many years. These are in the gift city and other places where if there is a tax holiday for a couple of years for eligible startups. It has been extended now till March 31, 2030 for the first 10 years. Then carry forward of losses on amalgamation. This is probably to fix up some loopholes which have been there, because people, when one company is merged into another, the loss from the previous entity gets carried into the second one. So sometimes people, when the 7-8 years are ending, before the end of 7th year, they form another entity, merge this into the other one, and then try to claim another 8 years. So it was sort of a evergreening of the losses, as they say. So they have tried to remove it, that overall the maximum limit will be 8%, 8 years only for carry forward losses. Then a tax exemption for from IFSCs for from non-deliverable forward contracts and offshore derivatives in IFC, they are exempt. Transfer pricing simplification has been announced, where one can use it'll be a 3-year block period, which will be used for the 3 years of income, and numbers will be used for calculating the transfer pricing for the transaction between the foreign entity and the US entity, where related entity transactions are there. The process for mergers and cross-border transactions are intended to be simplified. And as of course, there's a now after the budget on February 13, a new income tax bill was introduced in Parliament. Incidentally, one of the architects of this bill was one of the presenters in one of the forums 3 years back, Dr. Girish Ahuja. He presented one of those changes earlier. So he was one of the persons in the committee to draft the bill. The main aim is to tax rate and region for individual and corporates. Of course, they remain changed, but the main change is in the word, some simplification of the words, like the assessment year, previous year. These were confusing words. They want to make it simple, tax year, for clarity and understanding and compliance. Word counts have been reduced. Definitions are eased up. Number of sections have been reduced. A lot of complicated languages. The languages have been broken up into simple English, smaller sentences, and things like that. A lot of provisos, explanation, subsections, and all. A lot of them has been reduced, and some of the archaic provisions also have been removed, so that there's more clarity. Now, if you have overseas investment or income, basically there are a lot of compliance which everyone needs to do. These are the form, FinCET form, FBAR form is there, 5471 for reporting information return for people who have foreign corporations, if they have investment in foreign corporation, or if they are foreign shareholders, or there are US transfer of property to a foreign corporation. There 926 is there. 8865 is there is a US person who has interest in some foreign partnerships. 8938 is FATCA reporting for financial assets more than 100,000 for a joint filer. Then 8621 for reporting passive financial investment company, mutual funds, and all investment in overseas. And 8992 is the guilty tax on investment and on undistributed retained earning overseas. If somebody has not been in compliance, most of the penalties are $10,000 a year in terms of these non-compliance. But there is a streamlined process for coming into compliance, still open, with some penalty and filing prior returns, basically filing 3 years of return and 6 years of FBAR, and plus paying a compounding penalty. One can still come into compliance even for whatever was not done earlier. One of the one of the changes, clarification was done in this case is that earlier there was a lot of confusion that if somebody has not filed FBAR for many years and they have 10 accounts, so some revenue officers were charging 10,000 for each account. So now this case resolved that it will be not that non-filing of FBARs, and the IRS cannot impose penalty of 10,000 each and every account, but rather the penalty is per report. So for the whole report, 10,000 is there, not that 10,000 for each account. And then Banking Secrecy Act treats the failure to file a legally compliant report as one violation, carrying a maximum penalty of 10,000 instead of a cascade of such penalties calculated on a per account basis. Hence, the total maximum penalty is 10,000 per year and not per account. So that was a relief for many people who are not filing knowingly or unknowingly. So that's, thank you so much for sparing your time. If there are questions I can take. I think there are some questions which are there in the chat also. Maybe I should.
Yeah, Neeraj, there are a few questions.
Yeah, okay.
So one of the questions I think is on BOI filing. For non-profits is a 513C, right? Is it also needed for them?
Yeah, if they are, no, for non-profit, BOI filing is not there. They are exempt. They are from one of those 23 categories which are exempt.
Okay. And then there was a question regarding the child's unearned income. What is the child's unearned income?
Child's unearned income is essentially interest, dividend, dividends from capital gain, or basically those earned income is either salary or when you are working as a self-employed. But children normally get passive income like interest, dividend. Parents have put in some FDs for them, or grandparents have created some accounts for them. Unearned income is interest, dividend, capital gains, rental income, if any property is in their name. But let's say as a child is acting in a movie, a 5-year-old, and he earns that is earned income. So that's the difference.
Okay. So in that, even gift, is there a limit for gift where the child can receive?
The gift is the taxes on in the US, the gift tax is on the person giving, not on the child, on the recipient.
So that will fall under unearned income, or it doesn't matter?
No, that is not an income. That doesn't come in income at all.
Okay,
It is just a gift. Income is what is earned out of that money which is in the bank after that, once it's there in the bank.
Okay, and Ramji had, I think Ram Agarwalji had a question. The 2025 India budget is applicable 1st April
In most
2025.
cases, yes, but sometimes some of the provisions are effective immediately. Some are, but mostly yes. But sometimes, like indirect taxes, they make it applicable immediately the day it's announced.
Okay. I have a chat from Kaja. I don't know who the person is, but I think
You think that both options are available. Indexing, it's only for residents. They are not giving that to non-residents. That 20% and without 20% with indexation and 12.5%. Somehow it is it is not there for. There are some representations which have been made that it's whether it is inadvertent or whatever. The relief when it was announced, it was only for residents, not for non-residents. So it doesn't apply if people those who are living here.
okay. I think we have covered.
There is another one. I think U.S. gift tax exclusion is only for gift from U.S. resident to U.S. resident for gifts received from. Yeah, gift from overseas. Basically, it is because the gift is on the person giving the gift. So when somebody is giving from overseas, there is no limit to what a person in the US receives. Say, let's say somebody's parents or grandparents are living in India, they send $1 million. There's no gift tax on the person receiving. The only thing, there may be reporting requirement. Anything over 100,000 has to be reported. Such foreign gifts have to be reported.
Good.
I think there was one question in the original one also. I think One second.
Should we unmute all and have people
No,
also ask?
one second. I think there was some advanced question that is it correct that US levies tax on FDI in startups in India by US based investors mentioned by SBI? There's no tax on investment, but any income which is generated from the investment in India is taxable. But of course, there are some exemptions also, which I mentioned. Then there's another question of tax on real estate sale in India and repatriation. I think I covered that in the presentation. And somebody is asking for investment opportunities in India. Of course, there are a lot. I think there are tons. I think our Deputy Consul General did mention there is a lot of trade now between US and India. So a lot of options are there, which are there. Yeah.
Yeah, very interesting ones are, I think, the defense, healthcare, and manufacturing.
Yeah. So thank you everyone for spending so much time, your valuable time, everyone, and thanks Radhika, Atmaji, and Adlakaji for sparing your time. And it's an honor to be able to speak and present my views on these. So hope you all found it useful. Thank you so much.
Great. So yeah, a big thank you to all of you guys. A lot of good questions. I think there'll be the recording that if you need any of the recordings or the slides, please send an email so that we can send it across to you. Yeah, we look forward to have you in the next event. The next event I think is March 29th. So yeah, hope to see you there. And any other questions, if you have, feel free to send us a note so that we can kind of get back to you.